Hi, guys.
How's
Hello.
it going? How's it going?
Good, good, good. Yeah, let's see. Did you guys have to go into a weight room this time or no?
No, it let us right in.
Okay, yeah. See, I'm using I changed things over because now I'm using the college's subscription, and so I may have changed that setting so you guys could get right in then. So, okay, well, good deal. Yeah. All right. As per norm, looks like we'll have to wait a couple more minutes for the rest. MMU cage number 1 is my thing. I don't know where they get the name. So I don't know. Is Iowa's football staff going to be gone in the fall? What do you guys think? Did you guys hear Akram Wadley? You know Akram Wadley, star running back for him.
They've got some problems.
Yeah, he's saying, and it wasn't just Chris Doyle. He said Brian Ferentz used to make racial comments, and he said Kirk Ferentz took away the meal cards for players that weren't gaining enough weight. You know, I mean, sounds like some of those players act like they were really, and I mean, I'm sure some of it was to all players, but that when you played for Iowa, man, you were at the mercy of those coaches, you know, and they were very demanding and not always very appropriate in the comments made or the way they did things. I don't know. I don't know. I got to wonder if the rest of the staff is going to start falling like dominoes now, especially Kirk Ferentz and his son Brian. I got to feel like they might do. So.
Well, this is now that the first domino has fallen, this is going to be just like the Me Too movement, and people are just going to start swarming out of the woodwork with horror stories about what was going on.
Well, for the Iowa football program, they kind of already have, you know. So, I mean, because there's been quite a few athletes, football players come out and say that, which is really disappointing because I always thought Kirk Ferentz was a class act, you know. So hear anything different, and especially to hear that may have been somewhat, you know, mentally abusive to players, is disheartening for me to hear. And again, it's one person who is directly implicated, Kirk Ferentz. Others have kind of teetered around the edges there with Kirk. Brian Ferentz, his name's come up more than a few times. I got to believe the two of them are going to be linked. If one's gone, they're both gone. So, yeah, I don't know.
Well, the other one now is this coach, the field hockey coach that got fired a couple of years ago. Now she's come out and started.
Oh, the field hockey coach, Tracy Griesbaum, I think her name was.
Yes.
Yeah.
She came out and did an interview today too, and it's just adding fuel to the fire.
Well, maybe the AD
not directly related, but yeah.
Maybe the AD Gary Barta might have to go, right? Yeah, Barta's still he's still the AD. Yeah. Who knows? Yeah, it'll be interesting to see how far this goes, and obviously in a pretty short time before the fall seasons. Anyhow. Well, I don't know if we're getting anybody else, you know. I guess at some point we just got to go with what we got. And, you know, there's 5 of you guys on, and so we'll just go with it. I'll hit share screen here. Okay. But for chapter 4, oh, by the way, I put some new stuff on there under the content tab. I don't know if you guys have looked over the worksheets. I have a worksheet for test 1, of which 3 of those problems are going to be very similar to the problems on your test that you'll be able to access starting on Wednesday. And the other problem will be similar to, will help you with a lot of the multiple choice questions that, will be on. But anyhow, it's worksheet 1. You'll definitely want to do it before the test. I have solutions, which are check figures, but then I went ahead and added just shortly before class, added detailed solutions for that worksheet. So actually, let me show you guys here. Go ahead on a view like this. And okay, so under table of contents, here we've got, oh, actually, I think I already have them downloaded. Here is the worksheet for test 1. As you can see there. So initially there's some ratio questions, and then the next problem is where you actually have to do a statement of cash flows. You're going to have a problem very similar to this one on the test. Okay, you're also going to have a problem. This is from chapter 4 right now, which we're covering today. And this problem is from chapter 5, which we're covering tonight. And you will have problems similar to those. So, questions, somebody? So anyhow, the detailed solutions, which I see I misspelled solutions in the title, shows the same worksheet, only with all of the solutions done. Oh, wait a minute. Does it? Oh, it doesn't have the solutions for problem 1, but it does for problems 2, 3, and 4. Okay. So again, maybe at the end of class, we'll take another quick look at those, but I wanted to make you aware that that would be good study material before your test. Again, there is a 3-hour time limit. So while obviously any resource you want is available to you during the test, the 3-hour time limit is going to make it, really hard if a person is not already prepared going into the test to be able to answer all the questions, do everything. And that's like tonight now, where and I know one person said they were going to be, but people that aren't prepared for the test, they may not be able to finish it, even with a 3-hour time limit, which should be more than enough time if you're prepared. But again, don't just go into it cold. Try to prepare ahead of time. Did everybody get their homework, EXEPI homework 1 submitted then? I think, was it due last night? Was that the due date on that? Sunday night at midnight?
That's still coming up, isn't it?
Oh, it is? Oh, okay.
It's due the
I
5th.
think you put that in for July 5th.
Oh, I put it in for July 5th. Oh, okay.
Scared me.
Yeah, you scared me. I was like, no, I'm pretty sure.
I'm like,
Okay.
I'm
first or the
pretty
fifth.
sure when I submitted that homework from last week, it didn't have anything coming up for a while.
Okay. So let's see. Well, this is our 4th class then, right? So we'll do, okay. So we'll do the test here, we'll do chapters 4 and 5 tonight, and then the test between now and next week. Was that how I want to do it then, or should I? What did I tell you for the test? Did I tell you it would be this week? Well,
You don't have the test on the schedule on the upcoming events right now.
I thought you
I
said
don't.
Wednesday or Thursday.
well, yeah, I said, I definitely said it would be a Wednesday or Thursday. Let me do this. Minimize that and that. Let me go to the syllabus here real quick and see what date, because we were like a week behind originally. And then let me just move us here. But then, and I said, you know, that's okay because a lot of times it happens. I have so 3, 4. Okay, this is all stuff we'll do next class. And okay, so I do show the test 1 over chapters 1 through 5 on our next, oh no, that's tonight, right? The 29th. Yeah, okay, so yeah, it is after tonight. We're not going to be doing like all this stuff, but it shows for tonight. We'll be doing the stuff that that we had on here for last time. But yeah, okay. So yeah, we'll still plan the test then for this Wednesday or Thursday. You can do it either day. Just realize once you start, there is that 3-hour time limit then to finish. So, but usually I have the Accepi homework due before the test. That's why, okay, so let me, well, I guess that would, I have to go out to Accepi to find that. So the due date on Accepi when you go out there is next Sunday night? Well, let's go out there and see. Okay. www.accepi. And and I'll move this back over here. Assignment 1. Oh heck, I got a due date there for assignment 1. This is for you guys of July 31st. How did that happen? Okay. Well, obviously we need to clear all that up. I need to change that due date immediately. That is, make that due then. Okay, so we'll make it due Sunday night. It's 4th of July weekend, but you can have it done before then, right? Let's make it, go ahead and make it due that night. Okay. All right, there we go. And then let's go back and see what I have for assignment 2. They all changed to the 31st. I know I had these set at a different date and something happened. I must have gone in and changed one little thing and it changed all the dates on all the assignments. Okay, so that one's due the 5th. We'll go about 3 more weeks. Tentatively go for July 26th on that one. And let's see. So how do I get back to? Was it 2? And finally, assignment 3. Yeah, of course, it says the same date. That will be, we'll have to go into August there. August. And that would be, I think, August 9th. That should be saved that. All right. Yeah, sorry about that. I don't know why all those due dates went to the 31st. Here's the thing. Because most people then obviously do not have all of the Accepi homework done yet, and it's not due until next Sunday night, let's move the test to next Wednesday or Thursday that you can take, okay? So in fact, let me put an announcement on here right now, and the announcement will be, okay, new announcement, test 1, and we will say test 1 will be available to take on Wednesday, July. What is a week from Wednesday then? July
8th.
yes, okay. July 8th and Thursday, July 9th. Wednesday, July 8th, beginning at 8 a.m. and Thursday ending at 11:59 p.m. There is a 3-hour, whoops, what's going on? Yeah, oh, okay. 3-hour time limit. And publish. Okay, there we go. All right, so test one will be next week. Is that what you guys were kind of expecting? You know what? Usually I'm even a week behind where we are right now, and I guess this time the reason we're not a week behind is when we do the in-class test, we always watch that movie Too Big to Fail. And we didn't, because we're not doing it the in class course, we didn't watch that movie. So that's the reason that that we're actually normally. I'm thinking, yeah, we're about a week behind normally, and all of a sudden it's like, oh no, we're actually on time in this class because we didn't do the Too Big to Fail movie. Still recommend you guys watch it. How many of you, get everybody in here again, how many of you have actually seen the movie, Too Big to Fail?
I had you for Financial Crisis, so we watched it in that class.
Oh, okay, Tyrone, all right, you had it in there, yeah. And anybody who hasn't already seen it, it's a great movie, and it will help reinforce some of those things that that we went over in chapter 1 with regard to the financial crisis. Okay.
I have a question.
Yes. Who just?
This is Tracy. I don't know. I cannot find the ACCEPI instructions, and I saw it last time I was on here. Now I'm totally. I don't know. Can you remind me?
It's on the link is on the syllabus, Tracy.
Okay, I was not looking there. Okay.
Yeah. If you go to the syllabus, the link is on there. Mm-hmm.
Thank you.
Yes. Yeah. Okay. Any other questions then on where we're headed? So sorry, I thought I had those dates already set up, and was thinking, my mind's a little discombobulated with all this. Anyhow, I think what's that, Ismail?
Question about the movie. Take you back. This is gonna be like the different movie than Too Big to Fail, or just any kind?
Well, it's just I won't. I guess it's not required. I won't ask any test questions specifically about the movie. Although I have in the past asked like 1 or 2 multiple choice questions directly from the movie. But no, I won't. So it's just, that's a good one. Another one that covers a narrower segment of the financial crisis, but still talks about it. It's a little more complex to follow, is The Big Short. If any of you saw The Big Short, I think we covered that in that financial crisis course too, didn't we, Tyrone? Yeah. So
you know it.
Yep. All right. So we got The Big Short and Too Big to Fail. So got both of those. Yeah. They're both great movies to watch, but again, I won't ask any questions out of out of either movie for this course, since it's not something we can because of the formatting. So, okay. So now the one thing that this does mean, though, by moving the test, well, moving it, or let's just say having the test next Wednesday instead of this Wednesday, one thing about that does mean that we will be covering some new material next. Also, please make sure that you have financial calculators handy next week, because we'll be going over how to use the financial calculator. Now, again, some students have asked me in other classes, they're like, well, what if, you know, can I just do everything on Excel? I use Excel a lot. I like Excel, whatever. And you can. Normally in the face-to-face classes, I tell people no, because I don't want them all test on a laptop, communication reasons, but which typically isn't an issue with the evening population anyhow, but can be with the population. So yeah, but it might be easier for you to just go ahead. Well, there's Michelle. Yeah. Well, yeah, you weren't quite as late as you thought you were going to be anyhow. But yeah, so I think you'll probably find it easiest to use a financial calculator and to use that Texas Instruments Business Analyst 2 calculator. Now, here's the other thing I want to say. I'm planning that we're going to have our regular class meeting next Monday night. One potential issue is I am going to be in the Black Hills at that time out in South Dakota. A little family reunion out there. We're renting a house, really gorgeous. But anyhow, I don't know what our internet connectivity is going to be. So I don't know if that's going to be an issue Monday night or not. I'll know before Monday night whether it's going to be an issue. If it is going to be an issue, I'll see if there's somewhere else I can host our Zoom meeting for next Monday night. If it's still going to be an issue where I just can't find connectivity somewhere to host our Zoom meeting, then I'll probably just have to reschedule it. We'll have to have 2 meetings one week. I'm planning to have next Monday night Zoom meeting, and again, I do want to, though, just kind of warn you ahead of time. Watch your emails and everything, because if there is a problem with internet connectivity out there, I'll figure out a way to make up for that time, or maybe just do an hour meeting one day, or a 3-hour one night instead of a 2-hour meeting. Okay, so everybody knows where we're headed then. What's coming up? So Accepi would be due next Sunday night. Test 1 will be next Wednesday and Thursday. You can take it either day, whichever day works best for you. And tonight we're going to be covering chapters 4 and 5. And then again, next week, we will get into using the financial calculators. Make sure you have it available if at all possible next time. Okay, so chapter 4 is on forecasting. For the most part, the remaining chapters of the book, I'm not real tied to the book like I was with chapters 1, 2, and 3, especially 2 and 3. We went through the book pretty closely. The other chapters, it's not as necessary to do that. There's more key themes, less detailed examples that I need to do, and so forth. So when it comes to forecast, if you're going to do forecasted financial statements, you're going to be doing an income statement, forecasted income statement. You're going to be doing a forecasted balance sheet and statement of cash flows. Let me ask you guys, what is the first thing you're going to want to forecast? Because it's going to be the driver of a lot of your other numbers. What do you think you want to forecast?
Sales.
Mm-hmm. Exactly. Yeah. Yeah. You want to start with sales. Why? Because so many other numbers that you're going to be forecasting are going to relate directly to sales. Now, with the income statement, that's fairly obvious because some of our expenses are going to be fixed expenses. Others are going to be variable. Now, you guys tell me what's the difference. First of all, give me a definition of a fixed expense and then give me an example of a fixed expense.
Fixed expense is your mortgage. It's the same every month, no matter what you do.
Okay, so yeah, a fixed expense is one that isn't going to change no matter what your sales are. Okay, now you mentioned mortgage, and a business or corporation might have a mortgage too. While the payment may stay the same, the expense portion differs because, of course, with each payment, there's a different amount going to principal and interest than was the case, you know, the year before. So the actual expense part will be different, but the payment part won't change, right? So interest expense a lot of times is thought of as a relatively fixed expense. It's not going to go up unless you borrow more money, and you're not going to automatically borrow more money just because your sales increase. That doesn't mean you won't have to borrow more money if you increase sales. You'll see that as we get into further topics here in chapter 4. But you're not automatically going to have to borrow more just because you increase. Okay, so interest expense a lot of times thought of as a fixed cost. What are some other examples of fixed costs? Costs that aren't just automatically going to increase as you increase your sales.
Rent.
Rent. Okay, rent's a good example. Yeah, rent isn't just automatically going to go up because your sales went up. Okay.
Insurance.
Insurance, another good example. Yeah. All of those things are basically going to stay the same regardless of how much sales a company has. So if a company's sales are going to go up, those fixed costs aren't going to be affected by sales. So when you forecast your depreciation, another one, it's a non-cash expense, but it's still an expense that goes on the income statement, right? So those fixed expenses, and when we say fixed, it doesn't mean they can't change, because they can change. You know, rent can change periodically. Insurance premiums can change, you know, things like that. So a fixed expense doesn't mean that it never changes, but what it does mean is the change is at least not a direct result of a change in sales. Now, some people would say in the long run, there's no such thing as a fixed cost, because eventually if your sales go up enough, all of your expenses will have to increase. Well, okay, in the long run, that's probably true, but at least over a relevant planning horizon, you know, 1 to 3 year type planning horizon, generally speaking, you will have some expenses that, again, are going to be totally unaffected by sales. Doesn't mean they won't change, but the change is not a direct change in sales. So those expenses, when you forecast those, you know they're either going to stay the same, or if they're going to change, usually you would know that ahead of time. Okay. Because you would have planned for that change. You know, for instance, you'll know ahead of time if your rent or insurance premiums are going up. Now obviously you may not always know it right at the time you're doing a forecast, especially if we're doing a long-term forecast out 2 or 3 years. But long-term forecasts 2 to 3 years down the road tend to be a little more general than forecasts over the next month or the next quarter or even the next year, where we can get much more specific. Okay. So again, when we forecast the fixed costs, are either going to stay the same, or usually we're going to know what the change in those expenses. So what about variable expenses? That's going to be expenses that are directly related to sales. So give me an example of a variable expense.
Raw materials.
Materials. Yeah, raw materials. If you're a manufacturer, materials are definitely a variable expense. The more units you sell, the more materials you have to buy, and the more that goes in then to your cost of goods sold. So, the materials portion of your cost of goods sold is variable. Direct labor, that portion of your cost of goods sold is a variable cost, because obviously the more units you produce to sell, the more hours you're going to be working your labor force. Okay. What else? Sales commissions. Certainly, the more sales you have, the more commissions you're going to have to pay your salespeople. So that would be another variable cost. So on those, now, by the way, overhead, when we were talking about manufacturing, we said, well, materials, both direct and indirect, would be variable. Direct labor would be variable. Indirect labor, like for factory maintenance and things like that, typically would be a fixed cost, utilities for the factory, rent or property taxes on the factory. Those would all be fixed. It probably doesn't matter how many units we're producing in the factory. Those items are not going to be affected directly by sales. But the ones that are materials, direct labor, sales commissions, how would you go about forecasting those costs, expenses?
Take the average of what it's been previously.
Okay, relative to, because it's variable, it's going to be tied directly to what?
Sales.
Right, it's going to be tied directly to sales. So take it where it's been, what percent of sales have those expenses equaled, say, on average, like Tyrone said, maybe on average over, say, the last 3 years. Okay, well, if a cost is equal 20% of sales, roughly on average over the last 3 years, you'd probably forecast that it's probably going to equal about 20% of sales next year, right? So on the income statement, the variable expenses will generally be forecast as a percent of sales. Fixed expenses are just going to be either the same, they won't change, or if they do change, it's because of a known change or a planned change that's been made. Okay. Well, the same is true with the balance sheet. We tend to think of, well, fixed and variable items just being on the income statement, but a lot of the items on the balance sheet, a lot of your assets may vary directly with sales. Some of your assets won't have anything to do with sales. So, like, give me an example of an asset that if your sales go up, this asset account is going to increase as well. What do you think?
Accounts receivable or cash?
Accounts receivable for sure. Cash, it depends. Sometimes when sales go up, cash goes up. It doesn't always. It really depends, and part of that, depends on how well. There's something. What the heck? Trying to think of the term for it, but anyhow, there can be a lag time from the time you buy your goods until you sell them, and then if you sell them on credit, of course, there's more lag time until you actually collect the goods. So the cash collection period or cash collection cycle, cash conversion. That's the term. Cash conversion cycle. It's how long it takes from the time you actually pay cash for your goods until you receive cash from the sale of those. That cash conversion cycle for some businesses is very short. For other businesses, it's a lot longer. If you have a long cash conversion cycle, there's a good chance that if your sales go up, you may actually have less cash instead of more cash, because while your sales are growing, you're having to buy and pay for more and more inventory in advance of when you actually start receiving cash from the sales of that inventory. So in some cases, cash may go up with sales, may go down with sales. But accounts receivable for sure. Yeah, like you said, Langdon, definitely receivables. If your sales go up, certainly your credit sales are going to go up. If your credit sales go up, then it would only be natural that your accounts receivable balance would go up too. What else might be another variable asset that's going to go up, almost have to go up if you're going to increase your sales?
Your accounts payable is probably going to go up.
Okay, now that's a liability, but yes, accounts payable, because I'm going to have to buy more inventory if my sales are growing. That was the answer I was looking for on that. The other asset that goes up for sure is going to be inventory. Now I know, okay, Laura, you're kind of looking a little like, I'm not sure, but I mean, certainly there's times when
Actually,
you can
it's what I was thinking, but then I thought, well, I wasn't sure because.
Well, there's definitely times inventory could decrease because your sales are growing so fast, you just can't supply enough inventory. You can't buy enough or make enough, to keep it in stock. Certainly, there can be that issue. Under normal situations where we assume we have adequate, we can make an adequate supply of inventory or purchase an adequate supply of inventory. In those circumstances, then certainly we would expect that we're going to plan to hold or carry more inventory if we're going to have higher sales levels, right? Your inventory level is certainly going to have some relation to your sales levels. So if sales are growing, the company generally is going to want to carry more inventory. So that's another asset. But again, if they're buying more inventory, like Tom said, then they're going to owe more money on accounts payable to their suppliers as well. So accounts payable is one of those variable liabilities that will kind of automatically grow if your sales are growing. Because again, sales are growing, you're selling more inventory. That means you're buying more inventory. That means your accounts payable is going to go up. So that's a liability that's going to happen. The rest of the assets, so the rest of the balance sheet accounts, let's put it that way, may or may not be variable. It kind of depends on the company and the industry and the situation. Again, if it is variable, you may want to forecast it the same way as you do your variable expenses as a percent of sales. If, on the other hand, you have assets or liabilities that are not variable, for instance, plant and equipment, is that automatically going to go up as your sales increase? No, probably not. There can be some exceptions to that. Like if you're a restaurant chain or a store chain of some sort, what's one of the ways that restaurants or stores, retail stores might grow their sales?
Adding stores.
Exactly, add more stores, in which case certainly the sales growth is going to have a pretty strong correlation with your property and equipment if you're having to grow your number of stores, you know, in order to increase sales. So plant and equipment, it kind of depends. Again, in a case like that where we're looking at restaurant chains or store chains, retail chains that primarily increase sales by opening new stores and new restaurants, then yeah, even plant and equipment will probably be a variable asset. For other companies like manufacturers, et cetera, plant and equipment probably isn't going to go up just because sales go up, unless, of course, they're already operating at capacity. So if you're operating at capacity, the only way you can sell more units, you may be able to increase your sales in dollars just by increasing. But the only way you're going to be able to sell more units is to increase your plant equipment if you're already at capacity. So again, plant equipment might be fixed. If you've got excess capacity and you're a manufacturer, plant equipment is a fixed asset. It's not going to vary directly with sales. Liabilities, you know, bonds payable, notes payable. Not that you may not choose to borrow more money if sales are growing, but it's not going to happen just like, it's not like your bank loans are automatically going to go up as your sales increase, or your bonds payable are automatically going to increase as your sales increase, the way that, like, for instance, a payable. So again, on the balance sheet, the items that are fixed either stay the same, or you know what the change will be. Like on plant and equipment, you know, the gross plant and equipment probably isn't going to change, but because of changes in accumulated depreciation, which is a contra asset account, that's going to affect the net plant and equipment or net fixed assets on a balance sheet. So again, the fixed assets, fixed liabilities, things like that, they're either going to stay the same or you pretty much know what the change is going to be. But in the case of variable assets, certainly accounts receivable, typically inventory, those two for sure are going to be variable assets in almost all cases. Accounts payable is going to be a variable liability in almost all cases. So those variable items on the balance sheet, once again, you probably want to forecast as a percent of sales. So like Tyrone said with expenses earlier, same thing. Look at, well, what have they averaged as a percent of sales, you know, the last 3 years or whatever? They're probably going to average something close to that again this year. Okay. And then cash, if you look at the changes in the various balance sheet accounts, you look at the income from the income statement and the depreciation expense from the income statement, and then the changes in all of your various asset, liability accounts, et cetera, and put together the statement of cash flows. By the way, I will do, and I'm going to write this down, sometime before next week, I will put a review sheet on Brightspace that where I'll kind of just, you know, hit topics like, you know, topics. So I will have put something like that on. I know I already have it on Brightspace for chapter 1. I'll do something like that for chapters 2 and 3 and 4 and 5 as well. Yeah, just kind of a refresher. And then, of course, cash is going to be, well, whatever the beginning figure was, plus your net cash flows from your forecasted statement of cash flows, and that'll be your ending cash flows. Of course, that also means that when you forecasted your balance sheet, because we know assets have to equal liabilities plus stockholders' equity. Because of that, cash could also just be a plug figure on the balance sheet. You say, well, I got everything else. It's only going to my balance sheet's only going to balance if cash equals $30,000. Well, boom, then that's also what you should get when you add the net cash flows from your forecasted statement of cash flows, getting cash balance. You should get that same figure that assuming cash has to equal at the end of the year. Okay. By the way, just briefly, let's back up a minute. We said, well, you're going to start with your sales forecast. Okay. How are you going to determine your sales forecast? What are you going to look at in forecasting sales?
Just like the weatherman does. Just make it up.
Just pick a finger, put your finger in the air and say, okay,
Throw darts to the board.
This is going to be more the dartboard method. Yeah.
Yep.
Well, okay, let's try to be a little more scientific. Not saying weathermen aren't scientific, but they're not always accurate. And of course, sales forecasts aren't always going to be accurate either. And a lot of companies do give guidance to analysts about what they expect sales and earnings to be. And when they miss on guidance, stock price sometimes will drop pretty drastically. Okay, if we try to be a little more scientific, what would we look at probably for more than anything? If we're trying to forecast sales, say for the next year, what are we going to look at?
Prior sales?
Yeah, what were sales last year? And what about the year before that? And the year before that, is there some kind of trend of sales been growing? You know, well, if sales have been growing at an average of 5% a year, last 3 or 4 years in a row, there's a good chance, not guaranteed, of course, but a good chance sales may grow 5% next year. Obviously, we have to be careful about extrapolating past sales patterns into the future, but that's probably our starting point, is let's just extrapolate our past sales into the future. So if sales are on this trajectory, then future sales, we're gonna in our initial forecast, before we make adjustments, we'll probably say, okay, what if sales just do what they've been doing the last? But then you got to look at other factors that may affect sales, because things don't always happen in the future exactly the way they have in the past. So what are some things that may affect future sales in a way that wouldn't be accounted for just by looking at past sales patterns?
Pandemic.
Okay. Yeah, a pandemic. So, which of course the pandemic itself doesn't affect sales. It's the economic shutdown due to the pandemic that is affecting sales. By the way, I read something kind of comforting today. It's that, yeah, they're talking about all these cases going up all over the nation, but the death rate is going down. And I saw Iowa, was it yesterday? For the first time in 3 months, had 0 deaths from COVID. Now, maybe that was the day before. Yesterday or the day before, they didn't have anybody in the whole state die of it. So, which means 2 things, I think. One is that a lot of the people getting it are younger, healthier people who are out partying, you know, and whatnot. And they're less likely to get hospitalized, die from it. And number 2, hospitals, doctors, nurses, the treatments, they figured out better ways, options when it comes to treating COVID patients. So the survival rate, I think, has gone up significantly. So you put those 2 things together, that's good. I still say we're going to have a vaccine before Thanksgiving. That's at least FDA approved. But yeah, a pandemic and of course in normal years, even if you don't have a pandemic, you got to look at what's the economy expected to do. The economy was not expected to go into a recession, at least for most economists. Most economists were not expecting a recession in 2020, okay, before the year started. Obviously, things changed because of COVID, but so any given year, you want to look at, well, what's the economy expected to do? Almost all businesses are going to do better when the economy does better, and worse when the economy does worse. There's maybe a few exceptions, but there's not a lot of exceptions on them. Typically, businesses are going to have more sales, more earnings in a growing economy, less sales, less earnings in a recession. Okay, so the economy in general. What else?
New developments in the market.
The new developments in the market, such as?
I don't know. I'm thinking like Blockbuster and Netflix. Like
Sure, new
really read that one wrong.
Yeah, new competition, new technologies, new products that may change the demand for your product. And again, it could be like, where it becomes almost obsolete, like, Blockbuster because of Netflix and all of it. A lot of brick and mortar retail stores have ended up going broke because of Amazon and so forth. So they got to look, is there new competitors or new products that our products are competing against that's going to affect our sales? Or maybe we're the ones with the new product. We figured out something that's going to, that consumers are really going to like, and we're going to be able to deliver. That's going to increase our sales. Maybe we acquire another company. Of course, if you acquire another company, their sales become your sales. That's obviously going to have a big impact on sales. Generally, people within the company would do a forecast first for just the company without an acquisition. Acquisitions, even when they're planned, a lot of times fall through. But you probably might have one forecast without the acquisition, another one with an acquisition. Another thing besides just the economy with the pandemic, supply chain disruption. All of a sudden you can't get the stuff you need to make your product because of supply chain. We know that happened with COVID, but the same thing happened back. Remember a few years back when they had the earthquake and the tsunami in Japan? What was it? 10 years ago, something like that. 8 years ago, I don't even remember for sure, but a lot of factories got destroyed by either the earthquake itself or the tsunami that followed. Boy, talk about a 1-2 punch, huh? Man. So like Japanese automobiles, I know a guy just retired, but he used to be the manager of the Toyota dealership, Merrill Bewley City. And it couldn't get any cars on the lot because the Japanese car companies, even though some of them might have to do the final assembly here in the U.S., they couldn't get the parts they needed from Japan. So a lot of car companies got hit really hard, and it took a while to get that supply chain back going again. Same thing's happening now with COVID. Same thing could happen if there's a strike, So I remember years ago, Harley Davidson factory, the union went on strike, and boom, they had to shut down production of their most expensive model of bikes that they have the biggest profit margin. Well, you know, you do that, that's going to have a big impact on your sales and earnings. So again, now some of those things you can't really forecast. Who could have forecast coronavirus and its effect on the economy? I mean, nobody before this year, although I know some immunologists, scientists, whatever, have been saying sooner or later we're going to have this thing, this pandemic. You know, sooner or later it'll happen. You know, well, but nobody knew when. Nobody knew even if you know, they could say, yeah, sooner or later it's going to happen, but they didn't know how bad it may be or you know, whatnot. Luckily, it hasn't rivaled the Spanish flu, which I think they said killed like around 1920 or whatever. Didn't that kill like 50 million people worldwide? Something like that. Yeah. I think now we have around 500,000 deaths from COVID. Obviously, things have changed medically. Medical advancements a lot since too, but yeah, it's you know. So some things that those, by the way, are what we call. Have you ever heard the term a black swan event? When you hear the term black swan event, what that refers to is something that was just totally unforeseen and unpredictable. You could not have planned for. That's a black swan event. All we know is we do from time to time have black swan events. We just never know what exactly those events are going to be or when they're going to happen, and when they do, how bad they're going to be. Those are the black swan events. You know, as a company, can you really guard against those events? Well, you can to a degree. What could you do as a company to guard against black swan events? I mean, you can't stop them from happening, but how can you make sure you're going to survive those events?
You can be Scrooge McDuck and just sit on a big vault of cash all the time.
Make sure you've got plenty of cash and keep your debt levels reasonable so that if all of a sudden something major does happen and you don't have any sales for 3 months, you're not bankrupt because you can't pay your bills. You know, you don't have an excess debt. You've got a good amount of cash. I mean, obviously, there's a balancing act because you know, you don't want to have so much cash that you know, that isn't making any money just to plan for something that may never happen. But sooner or later, you know, something bad's going to happen. Black swan events happen. We do have bad things happen from time to time. We've had a lot of them in 2020 already, but you know, we'd kind of like to hit the reset button on this year, right? In some ways. In other ways, there's probably going to be a lot of good things come from everything that's happened in 2020 once we're through it all. Anyhow, so okay. So I did want to talk about those things. You know, so I'll probably have a multiple choice question or two, sales projection. So okay, you do your sales projection, you project the income statement and the balance sheet based on either fixed or variable expenses or fixed or variable assets in the case of the balance sheet, or fixed or variable liabilities. Now they did talk about something. I do want to look at one thing in the book, and it is, you do have a problem on it on the test. Let me do this. Let's go here. Okay. They talk about a required new funds formula at the end, toward the end of this chapter. Okay. Oh, cash budget. I'm not going to, and this production schedule, I'm not going to hold you responsible for that, if you're wondering. So there won't be a cash budget, won't be a production schedule that you'll have to. Okay, but percent of sales method, that is something that we're going to look at. And it is based on, I go with the formula. Here it is. Based on this formula right here. I do have this formula on the formula sheet. Okay, so here's what it says. RNF stands for required new funds. And here's what this whole formula is based on. It's based on the idea that, again, as we mentioned, certain assets, especially accounts receivable and inventory, possibly other assets as well, they're going to be variable. In other words, they're going to increase as sales increase. Okay, so what this formula is based on is, okay, if you're expecting an increase in sales, and thus you know that's going to cause an increase in assets, well, if assets go up, what else has to go up? Assets equal what? Day one accounting
Liabilities
one.
and owner's equity.
And equity.
Liabilities plus owner's equity, or with corporations, we call it stockholders' equity. So we know if assets go up, liabilities and stockholders' equity have to go up as well. Well, we know that while we'll have some variable assets, we're also going to have some variable liabilities. By the way, that's what the A stands for, is variable assets. L stands for variable liabilities. So we know, okay, accounts payable is going to increase. That'll help finance the increase in assets, right? And then we're also going to, this last part of the equation deals with an increase in retained earnings, because you're going to have some income from your sales. Now, some of that income may get paid out in dividends. The portion that gets paid out in dividends is obviously not available to the company to help finance an increase in assets. But the portion of income that is left within the company to increase retained earnings and thus stockholders' equity also helps finance the increase in assets. So that's what the whole formula is based on, okay? So like in this case, they have this example here in the book. They're saying, okay, let's say that the variable assets, those that are going to go up directly with an increase in sales, equals 60% of sales. And let's say this company expects an increase in sales next year of $100,000. Okay, so you take 60% of 100,000. This is A over S, variable assets over sales, times the change in sales. So you would have 60% of 100,000, or 60,000, is the increase in assets that you're going to have that results from your increase in sales. Okay. Now, again, if assets go up 60,000, we know liabilities plus stockholders' equity in total will also have to go up 60,000. We can explain where some of that comes from, because variable liabilities, like accounts payable, are going to equal 25,000, or 25% of sales. So if sales go up 100,000, they're going to go up by 25% of that amount, or $25,000. Okay. And then finally, we also know that if the company's profitable, unless they pay out all of their earnings as dividends, there's going to be an increase in retained earnings, which is a stockholders' equity account as well. So in this case, they're saying, well, they're assuming the profit margin. In other words, net income as a percent of sales is 6%. They're assuming total sales. That's why it's labeled S sub 2, because this is not the change in sales. This is total sales projected for the year. They're expecting, so in other words, in this example, they're saying we already had 200,000 in sales last year. We expect them to go up another 100,000 next year. So they're expecting 300,000 in sales next year. If net income equals 6% of sales, you're going to have $18,000 net income. Now, 50% of that is going to be paid out in dividends. That's what the D stands for. That stands for dividend payout ratio. In other words, what is the percent of earnings paid out in dividends? So if that's 50%, well, 1 minus 50% tells us, okay, I wish they wouldn't have used 50% because, 1 minus 50% is also 50%. So 1 minus that tells us 50% of the earnings are going to be kept in the company or retained within the company. So in other words, there's going to be a $9,000 increase in retained earnings. So you take the $60,000 increase in assets that results from your increase in sales, subtract out the $25,000 increase in liabilities that you'll also expect, and the $9,000 increase in retained earnings you're expecting, and you're left with $26,000 of required new funds, RNF. So in other words, the only way your assets can grow by 60,000, given that accounts payable or other variable liabilities will grow by 25,000 and retained earnings will grow by 9,000, is if you raise another $26,000 in finance, meaning maybe a bank loan or a bond issue or a stock issue. Okay, so that is your required new funds. That means you're going to have to go outside the company and again either borrow an additional $26,000 or issue stock for $26,000. Now, what if you don't do that? Well, then that means there's no way your assets could grow by 60,000. So which asset account would end up shrinking by $26,000 if you don't raise any new funds? Which one's most likely to decrease? Well, it's not going to be if sales are growing. It's not going to be receivables. It's not going to be inventory. It's not going to be
Profit margin?
Well, that's a ratio based on the income statement. But as far as a specific balance sheet account,
Cash.
cash, yeah, because like I say, your other assets, receivables, if your sales are growing, they're not going to go down, they're going to go up. If sales are growing, you're going to want to carry more inventory, so you wouldn't expect that to go down. Plant and equipment, again, that's not going to decrease when your sales increase. It may not increase either, but it's certainly not going to decrease. So of your major assets, what's left? Cash. So if you don't go out and raise those additional funds with either new debt or new equity, in other words, issuing stock, bonds or stocks, then you're likely to see a decrease of 26,000 in cash. If again, everything happens the way you think it will. That's why earlier, and I always get that when people say, well, sales go up. Yeah, you'd expect cash to go up. Yeah, but it doesn't always happen that way. Here's a case where if you don't raise that other $26,000, cash balance is not going to be able to go up. In fact, it may go down. Does that make sense? How about I give you guys a little problem like that and see if you guys can do it. How about that? Change things up a bit from just listening to me blabber all the time. Okay, so let me do this. Let me give you start a word here. Okay, so let's say now remember A is variable asset. Okay, let's say our variable assets equal $5 million. Okay, well, let me go back here. Let's change so I don't have dates after. Okay, now let's say my sales for the year were $10 million. Now, let's say I expect a change in sales. I'm going to have to move us down a little bit here. Okay, insert, and I want the change symbol, which is the triangle symbol. I got it here. More symbols. Yeah, I'm looking for a triangle. If you guys see one before I get to it, let me know. Okay.
Thought I saw one on the first screen you were on, like right in the middle.
See one? I
Yeah.
saw like a home plate looking type thing, but I
No,
didn't
there
see
was.
there was a triangle.
First line, I see.
Okay, let me cancel that and do that again then.
Yeah.
Where do you see the triangle at?
I thought it was right in the middle of that top block of symbols.
Oh, that's greater than or equal to, that's less than, and then all.
After you hit the more symbol.
Huh?
After you hit the more symbol, and then maybe you'll see.
Yeah, did it moved or what?
I don't
Yep.
see your symbols currently, so I can't help you.
Oh, you can't see my symbols right
No.
now?
Yeah,
Nope.
yeah. Hit okay. You can hit the more symbol, and then maybe you can. Yeah.
Yeah, more symbols.
Okay,
Okay.
right under 5/8.
Right under 5/8.
Yeah. There's under. Yep.
Ah, thank you.
Yeah.
There we go. All right. Okay, so now we'll put the change in sales. All right. Well, let's say the change in sales is expected to be $2 million. So they expect sales to go up by $2 million. Okay. Let's see. Now, variable liabilities, like in the form of, say, accounts payable, et cetera. Let's say they happen to equal $1 million. Okay. And then let's say the profit margin is expected to be 5%. And let's say the dividend, and payout, dividend, I am the world's worst type of dividend payout ratio is, let's say, 40%. That should give you everything you need. You guys now find your required new funds. So you guys take a few minutes, figure that out. Would it help to have the formula in front of you too? Yeah. Okay. Let me, give me a second here. Let me do this. And then, and then let me put my formula sheet up. Oh, here's the formula right there. Okay. Variable assets to sales times the change in sales minus variable liabilities sales times change in sales minus profit margin times total sales times 1 minus the dividend payout ratio. Okay. Now you got the formula up there. You can see it, right? You guys can see my formula or the book's formula. Okay. And the sheet.
Yeah.
Take a couple minutes, try to figure that out.
Do we need the new sales level?
Well, you can figure it out because if sales were 10 million
Oh,
and
yeah.
an
Okay.
increase by 2 million, then of course the new sales level will be 12 million.
Okay.
Yep. Kind of from the people I can see, not everybody wants to be seen, but the ones I can see, it's like some are done, some are still working. So I'll give you another minute or so. All right, what'd you end up with? Kelly, what'd you get?
620,000.
Not what I got in my head, but my head could be wrong. Okay.
Okay.
Ishmael, what about you? Whoop, you're muted, Ishmael. Your mic is muted.
Yeah, I didn't finish the.
Oh, you're not finished yet. Okay. Laura, are you finished?
The first
Yeah.
part.
Oh,
Go ahead.
I got 3,400,000.
Not what I get in my
Okay.
head. No. In fact, that one I know for sure is wrong because it's always going to be less than the change in sales.
Okay.
Well, I guess I better not say that. Not automatically. But yeah, that's wrong. That one I know. Okay. Let's Tracy, how about you?
Oh, that's what I did wrong.
So do you know it now?
Yeah, I took the sales, not the change in sales. That was my fault.
Oh, okay. Was that you, Laura?
Yeah.
Oh, okay, gotcha. Okay. Tracy, how about you? What do you got? Tracy, not there. Okay. Langdon?
440,000.
How what I got? This answer is kind of like a fingerprint. Everybody's is different. Tyrone, what about you?
Yeah, I'm not really sure. I'm not
Okay.
sure I'm doing this right.
All right. Okay. How about Rihanna or Michelle? Either one of you guys want to tell us what you got?
I got the 440,000.
You did. Okay. And Rihanna, how about you? Okay, no Rihanna. All right. So here's what we got. All right, so we're gonna take, by the way, I'll just do my numbers in thousands. We're gonna take those variable assets, 5 million, and divide that by total sales of 10 million. So that means variable assets equal 50% of sales. So if I then multiply that by the increase in sales of 2 million, that tells me, I'll go down below here and just tab over. That tells me, okay, if my sales go up 2 million, since variable assets equal half of my sales, my variable assets will increase by 1 million, right? Okay. Now, next, I'll subtract out. So that was my A over S times the change in S right there. A was the variable assets of 5 million over S, total sales of 10 million. And then I multiplied that by the change in sales of 2 million. So again, my assets equal, my variable assets equal 50% of my sales. If sales go up 2 million, those assets go up 50% of that amount or 1 million. Okay. Now, subtract from that variable liabilities over sales times the change in sales. Well, my variable liabilities, we said, were 1 million. Divide that by 10 million in total sales. So they're going to equal 10% of my sales. So if sales go up 2 million, they'll go up by 10% of that amount or 200,000. So I'll just tab over here and tab again and say, okay, so that's a $200,000 increase in variable liabilities. It's going to help finance $1 million increase in assets. Okay.
Apparently
Lastly,
is 20,000.
oh yeah, 20 instead of 200.
I need that extra zero.
Yep, that'll make a big difference. Yeah. So that was the L over S times the change in S. Variable liabilities, the L is 1 million over total sales of 10 million, or means it's 10% of sales, times the change in sales of 2 million, means, okay, 10% of 2 million is 200,000. Finally, take the profit margin of 5% or 0.05. We're going to multiply that by total projected sales, which if sales were 10 million and they're projected increase by another 2 million, that's going to be 12 million. And again, my numbers are in thousands here. And then, and by the way, just that alone, taking that net profit margin times total projected sales, what am I actually finding there? I mean, I know what the number is going to be, but what am I actually finding? Projected net income, right? Because your profit margin is net income as a percent of sales. So if my net income is 5% of sales and total projected sales are 12 million, then I'm projecting that I'm going to have net income equal to 5% of 12 million, which would be $60,000. Now, not all of that 60,000 though is going to be available to help finance my increase in assets. Why? Whoops. Why? Because I'm going to be paying some of those sales out or some of those earnings out in dividends. So I'll have 60,000 of income, but I'm going to pay 40% of that in dividends, meaning 1 minus 40% or 60% of those earnings will be available to help me finance the increase in assets that results. So 5% of 12 million is 60,000 times 1 minus 0.40 or 0.60 means I'm adding 36,000 to retained earnings. So that's going to give me 100 or a million minus 200,000 is 800,000 minus another 36,000 is going to be 764,000. I'll go ahead and save that. Save as required new funds are example. Okay. Any questions on that? So is everybody who did not get that answer see why they should have gotten that answer? Okay.
Yeah, I see.
Okay. Okay. And then, of course, you'll get more practice with the Accepi homework, and also on the worksheet, there's a problem on that as well. Okay, so I'll go ahead and minimize that. Yeah, because I do want to get most of chapter 5 done yet tonight. So I'll minimize that. Okay. So then moving into chapter 5, we'll go back to our big. Moving into chapter 5, what does chapter 5 deal with? Well, chapter 5 deals with leverage. Okay, that's what we call it, leverage. There are 2 types of leverage. There's operating leverage and there's financial leverage. Now, what does that refer to? Operating leverage refers to the use of fixed costs versus variable costs in your operations. Okay. So that's what operating leverage refers to. Fixed costs rather than, the use of fixed costs relative to variable costs in your operations. Now, think about it. Here's the thing about fixed costs. When your sales go up, your fixed costs don't go up, right? Variable costs do, but your fixed costs don't. So because of operating leverage, because you've got fixed costs that aren't going to go up just because your sales go up, that operating leverage is generally going to means that your profit margins will go up the higher your sales. So in other words, operating profit can increase at a greater percent than sales. So your sales might go up, say, 5%. Operating profit might go up, say, 10%. Why? Because a lot of those expenses that you have to subtract from sales don't go up just because your sales go up. Okay. Same thing then with financial leverage. Now, financial leverage refers to the use of debt versus equity finance. Well, with debt financing, we have another fixed expense, interest expense, right? Interest expense doesn't automatically go up just because our sales go up. I mean, if we choose to borrow more money, it will, but only if we choose to borrow more money. So interest expense does not automatically increase due to an increase in sales. So for that reason, your operating profits might go up 10%, but your net income, or if you want to take it a notch further, earnings per share might go up 20%. Okay. I think it's easier to see with examples. Now, let me say this. Well, first, let me kind of scroll through chapter 5 to show you how they cover it, and then what parts I'm going to kind of ignore, right? Okay, so
Can
let
I
me do
ask
that.
a question real quick?
Yeah.
Back on the, sorry, I'm stuck on this math.
Okay.
I don't know how you got 36,000 because I got 360,000. Am I
Oh,
crazy?
did you? Okay,
Me
well,
too.
let's, you did too.
Yeah, because when I take 12 million times
Whoops.
0.05, I get 600,000, not 60.
Let's see, when you take
When I take
5% of
5 times
12 million,
it's 600,000, not 60,000.
oh, you are so right.
I just thought I was doing something wrong, so I'm glad you asked that question.
No, thank you, Michelle. You are so right. That's Michelle, right? Talking?
Yeah.
Okay, I thought so. Okay. Well, thank you. You are right. That's 6 million, not I'm sorry. It's 600,000, not 60,000. And of course, 600,000 times 60% is 360,000, not 36,000, which is why those of you who said 440 were correct. Yeah. Right? Yeah. Million minus 200 be 800, minus another 360 be 440. You are correct. Thank you, Michelle, for pointing that out. Yeah, for some reason I was thinking, 5% of 12 million is going to be 60,000. No, 600,000. Correct. And of course, 60% of 600,000 is 360,000. Thank you so much. Okay, my bad. Sorry about that, guys. Especially those of you that got 440. You had it right, and I'm telling you it was wrong. Yeah, sorry about that. Okay, well now, let me do this. Let me start another, let me first scroll through chapter 5. Okay, because I think that was pretty much, that was it for chapter 4. Okay, so now I'm going to go to chapter 5. Okay, operating and financial leverage. Break-even analysis, we will look at that too. Okay. These formulas here, using actual fixed cost, oops, not that one, not the break-even, sorry. The operating leverage formula. This right here, these are the formulas that we're going to use for the degree of operating leverage. Take the percentage change in operating income divided by the percentage change in sales. They do give you this formula down here, using quantity and price and variable cost per unit and all that. Yeah, you don't need to know that. Okay, that alternative. Then for the degree of financial leverage, Okay. They use this formula, percentage change in earnings per share divided by the percentage change in EBIT, the earnings before interest and taxes, which is of course the same thing as operating profit. This formula here for the degree of financial leverage, again, don't worry about it. We're going to use the percentage change formula. And then finally, you can combine the two to come up with what we call a degree of combined leverage, is a percentage change. Again, I wish they used net income. They use earnings per share over the percentage change in sales. Why do I wish they used net income? Because one of the things that could cause a percentage change in earnings per share that is unaffected by leverage is if the company just buys back some stock. That's going to change the number of shares outstanding, which changes earnings per share, and that has nothing to do with your leverage. So I really wish they would have used net income rather than earnings per share. But again, to avoid confusion, I'll be consistent with the book. So we'll use earnings per share and just assume the number of shares outstanding do not change. And then you can ignore this formula, quantity and price and all that for the degree of combined leverage. Okay. And there we go. That's what they cover. So let me do this. Again, let me open a Word document. Okay, so I'm going to start with sales. And then I'm going to have minus total variable costs or expenses. Let's call them expenses. Oh, spelled correctly, expenses. And again, let's maybe take a space after each. So, well, sales, let me back this one. Okay, sales minus total variable expenses minus fixed expenses going to equal our EBIT, earnings before interest tax. Now I know normally on an income statement, it's sales minus cost of goods sold, gives you gross profit. Then you subtract out selling, general, and administrative expense, and along with then depreciation expense to get earnings before interest and taxes. Well, I'm just going to throw the cost of goods sold and your SGA and depreciation expenses. They'll all be buried somewhere under either variable expenses or fixed expenses. Okay, obviously depreciation will be in the fixed expense category. Some other things may be there as well. The variable expenses would be our direct labor, materials, etc. Okay. So, and then from that, I'm gonna have minus interest, okay, which gives us EBT, earnings before taxes. Then I'm gonna have minus taxes, which equals earnings after taxes. And then I'm going to put divided by, I'm going to need another mass symbol here. There's divided by the number of shares standing, which gives us then earnings per share. Okay, so tab over here. Actually, let me move that down a couple lines. And then I'll go back up here, tab over a bit. I'm going to have, I'll underline it and put it in bold. I got year 1. Okay, take the underline out, tab over, and then I'll have year 2. Okay, let's say now I'm doing sales, tab over here, and let's say sales in year 1 are $1 million. Okay, and let's say then in year 2, they go up 10% to $1,100,000. Okay. Now, let's say our variable expenses, I'm going to say those equal 40% of our sales. So at 40%, that's going to be 400,000. Help me if I mess up on my zeros again, guys. Well, and I maybe even need to back one more. There we go. Okay, so of course that's on $1 million of sales. So if my variable expenses equal 40% of sales, on 1.1 million, they're going to be 440,000. Okay. I think that's lined up. Anyhow, fixed expenses. Well, let's assume initially that my fixed expenses are 0. So if they're 0 in year 1, then we would expect them to be 0 in year 2. Now let me underline there and there. I don't know why I put the double under over here. Okay, whatever. Anyhow, well, that's not what I meant. Okay, now, what is EBIT, earnings before interest tax? Well, obviously, in year 1, well, it's going to be 600,000, right? And in year 2, it's going to be 660,000. Now, what about our interest expense? Well, again, initially, let's just assume interest expense is 0 in year 1 and 0 in year 2. Okay. Again, I'll underline those, underline there, and underline here. This one. Okay. And that's going to give us earnings before taxes of 600,000 year 1. And of course, we tab over, and it's 660,000. What just happened? 660,000 in year 2. Now, taxes. Let's assume our tax rate is, let's just go a nice even 30%. Okay. So with a 30% tax rate, taxes in year 1 be 180,000. And taxes in year 2 are now going to be, well, let's see, 30% of 60 is 180 and another 18. So it's going to be 198,000 in year 2. Again, we'll underline those amounts and underline here. Okay, so net income year 1 is going to be what? 420,000. Next year, it's going to be 462,000, correct? Now, just to keep the math simple, let's assume in year one, our number of shares outstanding is also 420,000. And of course, it's going to stay the same. We have to assume it stays the same since that's our book uses earnings per share rather than net income formulas. So earnings per share, well, 420,000 divided by 420,000 is going to give us $1 even in earnings per share. Now, 462,000 divided by 420,000 is going to give us $1.10 in earnings per share. So if I was now to compute the degree of operating leverage, my DOL, remember, remember the degree of operating leverage equals the percentage change in operating profit. Well, how much did operating profit go up here? 60,000. Okay. I divide that by the beginning operating profit figure of 600,000. And then that will give me my percentage change in operating profit. Well, then I have to divide that number by my percentage change in sales. Here, what's my percentage change in sales? Well, sales went up 100,000. On a total of 1 million to begin with. So now I'm just going to do this. I can't make this look real pretty, guys, without needing a lot of help. So I'll just do it this way. So that means I've got a 10% change in operating profit divided by a 10% change in sales. So my degree of operating leverage would be exactly what? Meaning for every 1% sale increase I had in sales, I had a 1% increase in operating profit. When sales went up 10%, operating profit went up 10%. That happened because I didn't have any fixed costs. So I'm also going to do another example after this. Okay, now let's do the degree of financial leverage, which we know equals the percentage change in earnings per share. Well, earnings per share increased by 10 cents divided by $1 to begin with. And again, I'll underline that. And whoops, right below that. And by the way, maybe I get a little. There we go. Okay. And then below that, I'm going to go, okay, well, what was my change in operating profit? Well, again, that was the $60,000 increase. 60,000 divided by 600,000. Why did I still get that line back? Yeah.
You have underline highlighted there. You got rid of it now.
Okay. Yeah. All right. Yeah. You guys get the idea. Okay. I'll just tab over a bit and put equals. So again, I have 10% change in earnings per share divided by 10% the change in operating profit, which again equals 1 as my degree of financial leverage. So finally, for the degree of combined leverage, Okay, take my 10-cent increase in earnings per share divided by the dollar to begin with. And again, I'll underline that. And then enter and take the other out. Okay. And I divide that by my percentage change in sales, which was 100,000 divided by 1,000,000. Okay, which again, now I'll tab over, equals 10%, the change in earnings per share, divided by 10%, the change in sales, which gives me a degree of combined leverage of 1. So here's what I'm saying. If variable costs continue to maintain the exact same percent of sales as they did before, and the tax rate does not change, if there's no fixed expenses and there's no interest expense, you would expect earnings to go up at the same rate as sales. So sales go up 10%, operating profit goes up 10%. Operating profit goes up 10%, earnings per share goes up 10%. And so forth, right? Okay. Save this because I'm going to also now change it. Save as leverage example. Okay, leverage. There we go. All right. I'm going to copy all this and starting from here all the way down. Copy. And now do something different down below. Okay, so see if I still got enough sheet. I think I do. I'm going to hit paste. All right. But here's what I'm going to do the second time down. I'm going to change these numbers. Oops, I better tab this over. All right. Do I tab one more? Nope. Okay. All right. So now what I'm going to do is I'm going to throw in some fixed expenses and some interest expense. So let's say, well, on top of having 400,000 in variable costs, let's say we have 200,000 in fixed costs. Well, the next year then, we're still going to have, still going to have 200,000. Damn it. We're still going to have 200,000 in fixed costs because that was unaffected by sales. So it didn't matter whether sales is 1 million or 1.1 million, those fixed costs aren't going to change. Okay, so now what was our operating profit year one? Well, 1 million minus 400,000 minus 200,000, line that up a little better, is going to give us operating profit of 400,000. And the next year, 1,100,000 minus 440 and minus 200 is going to give us 460,000 in operating profit the next year. Now, let's assume that we also have, let's say we also have 100,000 in interest expense. Okay, I'll underline that. And over here then, we got 100,000 in interest expense. And put a line there. All right. So now earnings before taxes, 400 less 100 would have been 300,000 in year one. 460 minus 100 would have been 360 in year two. at a 30% tax rate, well, that's going to be $90,000 in taxes in year one. Move it over a little more. Okay. In year two, well, 30% of 300 is 90, and 30% of another 60 is 18. So that's going to be 108 in year two. So earnings after taxes year one is now going to be 210,000 instead of 420. Okay. In year two, it's now going to be 262,000, right? 360. No. What does that equal? 52. 252. 252,000. Just tell me if I'm doing any math errors as I go. All right. Now the number of shares still we're saying 420,000. So 210 over 420 means, oh, okay. Now that I threw in some interest expense and some fixed costs, my earnings per share in year one would have only been 50 cents. Whoop. And 252 divided by 420 is going to be what?
60 cents.
60 cents? Okay. Is going to be 0.60 cents a share. So now let's compute our degrees of our degree of leverage. And what you see is, okay, well, this time operating profit went up 60,000 on just 400,000 to begin with, right? So 60 over 400,000, that's a 15% increase in operating profit. Now the percentage change in sales is still 10%. Sales just went from 1 million to 1,100,000. Okay, so that gives us now a degree of operating leverage of 1.5. The degree of financial leverage, well, earnings per share again went up 10 cents, but now that was on only 50 cents to begin with. So the increase in earnings per share is 20%. Divided by, again, it would have been 60 over 400, or a 15% increase in operating profit. So that's going to be 1.33 times. And finally, down here, we have because earnings per share went up by 10 cents on 50 cents to begin with, that was a 20% increase in earnings per share due to a 10% increase in sales. So we have a degree of combined leverage of 2. Okay. So what happens is, because we put in some fixed costs that did not go up when our sales went up, our operating profit actually increased by a larger percent than our sales, giving us a degree of operating leverage of 1.5. Meaning what? Meaning for every 1% change we had in sales, we had a 1.5% change in operating profit. So when sales went up 10%, operating profit went up by 1.5 times that amount, or 15%. Okay? On a financial leverage, we see earnings per share went up due to the fact that we had interest expense. While operating profits went up 15%, earnings per share actually went up 20%, because that interest expense also did not go up just because sales or operating profits went up. So even though operating profits only went up 15%, earnings per share went up 20%, or 1.33 times as much as operating profit. So finally, when you combine the effects of the two, you got a 20% change in earnings per share over a 10% change in sales. So the percentage change in earnings per share is twice as great as your percentage change in sales. And again, why? Because of those fixed expenses and the interest expense, which means because those costs don't go up as your sales increase, you can see a much greater percentage increase in profits and earnings per share than the percentage increase in sales when you have fixed costs and fixed interest expense. That's why a lot of times a company will have only a small percentage increase in sales, but if they have a lot of leverage, they'll have a large percentage increase in profits because of those fixed costs. Questions? So I got this saved now. Okay, questions. Did I lose some people? It seemed like we were bigger. Oh, okay, Tyrone's back. Okay. Any questions? I will put what I just did on Brightspace also. Okay. So you will have a problem where you're gonna, on the test, where you're gonna have to do this. You're gonna have to fill in the second column. I'll tell you, okay, here was everything for year one, and then I'll just give you like sales for year two. And then you guys will go through, fill in the new numbers, you know, for year two. Of course, again, the fixed expenses and the interest expense, remember, don't change. And then you'll compute the percentage change in one over the percentage change in the other so that you're finding your degree of operating leverage, degree of financial leverage, and degree of combined leverage. By the way, one thing you could note, what happens if you multiply 1.5 by 1.33? Well, because this is really 1.33333 continuing, you actually, if you multiply your degree of operating leverage by your degree of financial leverage, that gives you the degree of combined leverage. That'll always be equal to the degree of operating leverage times the degree of financial leverage will always equal the degree of combined leverage. So any questions on that? All right. And then I'll do, so I saved that. I'm gonna minimize that. The last thing I have to talk about is break-even analysis. Super simple. Okay. What is your break-even point? Well, that's gonna equal your fixed costs, total fixed costs, divided by, underline it here, divided by, whoops, damn it. Yeah, I always gotta fix everything back. Okay, and I'm dividing that. Yeah. By my selling price, I'll put it in parentheses, selling price per unit minus your variable cost per unit. Actually, let me maybe try to just tab that over. Okay. That's your break-even point in units. Why do we compute break-even points? Well, for one thing, you know, before you ever get involved in a project, a business project, you'd want to know, well, how much sales do I need to generate to break even, right? Because if it's not realistic to be able to generate the level of sales you need to break even, or better yet, make a profit, then why would you get into that venture, right? So now let me give you an example. Let's say a company has fixed costs of $100,000, and let's say the selling price per unit is $20. And let's say that the variable cost per unit is $10. Take a minute, and if it even takes you that long, figure out how many units you have to sell to break even. You got it, Tyrone?
Like 100,000.
I think I got it.
100,000. Huh?
I think I got it. I got 10,000.
10,000. Yeah, it's going to take 10,000 units to break even. So what you do is you divide the 100,000 by selling price of 20 minus the variable cost of 10. 100,000 over 10 equals, equals 10,000 units.
Yeah.
Break even. And of course, if you took the 10,000 units, and multiply that by the selling price per unit of $20 per unit, that means it's going to take in sales dollars, $200,000 of sales to break even. Okay, I'll go ahead and save that. Save as break even. Simple. So you'll have a multiple choice question where you got to do that. Find your break even. Pretty easy. Again, just and so what you would do is ask yourself, well, is it feasible that I can sell 10,000 units or have a total of $200,000 in sales for this business? If it's not feasible, then don't do it. There. That's chapter 5. Questions? Oh, let me show, here's that break-even chart they show you right here. Okay, so here's units on your horizontal axis. This is dollars on the vertical axis. Okay, what they're saying, whoops, in this chart, why am I, oh, I had that problem another time. Okay. What they're saying is, okay, your fixed costs, since they're going to be the same no matter how many units you produce, that's going to be a straight line going all the way across. Now, we know variable costs will go up the more units you produce. So your total cost line is going to equal the fixed cost plus your variable cost. So it's going to start here Because if you have 0 units, make 0 units, your total cost would just equal your fixed cost. And then, of course, your total costs go up the more units you produce because of those variable costs. Well, then this is your sales line. Because, of course, if you sell 0 units, you got $0 of revenue. But then, of course, the more units you sell, the more revenue you're going to have. So at this point right here, where your total revenue equals your total cost, that's your break-even point. Prior to that point, you've got losses. After that point, you've got profits. Now, I think in this one, they're trying to show us a company that doesn't have a lot of leverage. Why would I say that? Because the fixed cost line is very low here, and the total cost line is very steep. That means most of their costs are variable rather than fixed. So they don't have a lot of leverage. They may have shown one for a company with a lot of leverage before that. Yeah, here's one for a company with a lot of leverage. So a much higher fixed cost line, but then the total cost line isn't nearly as steep. They don't have near as much in variable costs. Sales line still looks the same. So notice with a lot of leverage, it looks like while you're gonna have to sell more units to break even, your potential profit once you get past that point is much wider. But of course, prior to that point, you also have bigger losses. So let me put it this way. The more leveraged a company is, the more risky they are, okay? A highly leveraged company will have a much greater fluctuation percentage-wise in profitability than a company with a low amount of leverage. So having a lot of leverage, whether it's in the form of financial leverage, which comes from interest-bearing debt, or operating leverage, which is just fixed cost, having a lot of leverage does make a company more risky. Because again, those fixed costs have kind of an outsized impact on earnings relative to any changes in sales. Questions? That's chapter 5. I know we went a little long here. We're at 2 hours, 15 minutes. Any questions? Okay, well, I'll go ahead and put those little examples I worked up tonight. I'll put those on Brightspace for you to look at. And meanwhile, you guys have a great week. Expect to see me next Monday night. And again, I'll find out when I get there how good the internet is and what the Wi-Fi and whether I'm actually going to be able to get through a Zoom meeting. So I'll kind of check it out when I get out there. I get out there on Friday. So just watch for any emails or announcements. If I have to, I could potentially end up saying, hey, we're going to have to make this class up. I just don't have the connectivity I need to be able to run a meeting. But we're going to try. So just plan to be here Monday night unless you're different. All right, guys. Thanks for being with us. I'll see you next week. Don't forget, Acceppi's due Sunday night. Yep. Bye-bye, everybody.
All right.
Damn it. There we go.
Hey, I got a question for you.
Yeah.
So the homework that I turned in early last week,
Yeah.
I revised it and I redid it while we were in class. Can I email that to you again?
What is it? The Acceppi homework you're talking about?
No. The financial analysis questions.
Oh, yeah. Yeah.
That I
Actually,
had
why don't
already
you
turned
just
in.
resubmit it to the Dropbox, even though it's past the
I
due date?
tried
It should
to,
let
it wouldn't-
Oh, it wouldn't let
it
you to
wouldn't
resubmit? Oh,
No, I
okay.
didn't only have, it was a one-shot submit.
Oh,
And some of
okay,
my
because
answers
usually
were
you
right.
can still submit more. Yeah, that's fine, Tom. Go ahead and email it to me then.
Okay, I'm going to shoot it across to you an email right now.
Okay, no problem. Anything else?
Oh, I think we lost Rihanna a long time
Well,
ago.
yeah, I don't think she's still there. She would have left by now.
I am
All
going
right,
to.
we'll see you, Tom. Bye.
Yeah, hey, I'm going to respond to your Zoom email with this financial analysis doc.
Okay, that's fine. Yep.
Yep.
All righty.
All right. Thank you. Appreciate
You
it.
betcha. See you next week.
Yep. Good night.
Good night.